Before money existed, value still existed. People needed food, tools, shelter, protection, but there was a problem. You couldn't buy anything because there was nothing to buy it with. You had to trade. If you were a farmer with grain and you needed shoes, you had to find a shoemaker who wanted grain. Not tomorrow, not eventually, right now. This was called barter. Direct exchange. Item for item. Need for need. It sounds simple, primitive, almost pure. But it was deeply flawed. Because barter only works if both people want exactly what the other has at exactly the same time. This was called the double coincidence of wants. If the shoemaker didn't need grain, but instead needed meat, the farmer had to find a hunter, trade grain for meat, then find the shoemaker, trade meat for shoes. Every transaction became a chain of dependency. Every exchange required negotiation, coincidence, and luck. Barter didn't scale. It couldn't support cities. It couldn't support empires. And yet for thousands of years it was all humanity had. So humans began to improvise. Instead of trading goods directly, they began using objects that represented value. Livestock was among the earliest. A cow could feed a family, provide milk, produce offspring. Its value was universally understood. The word capital itself comes from the Latin word caput, meaning head, as in head of cattle. Wealth was literally measured in living animals, but livestock had limitations. You couldn't divide a cow easily. You couldn't transport wealth across long distances safely, and cows could die. So humans experimented with smaller, more durable forms of value. Grains became a medium of exchange in agricultural societies. Standardized quantities of barley or wheat could be measured, stored, and traded. Cowrie shells became currency across Africa, Asia, and the Indian Ocean. Small, durable, and difficult to counterfeit, cowries were used as money for over 4,000 years. Beads, stones, salt, metal fragments, each represented something deeper, agreement. Money is not valuable because of what it is valuable because people agree that it is. But even these early forms had limitations because carrying physical goods was inefficient. The real breakthrough came not from objects, but from accounting. Around 3000 BCE in ancient Sumer, in the region we now call Iraq, humanity invented something far more powerful than coins. They invented money that existed only as information. The Sumerians built vast temple complexes that functioned not only as religious centers, but as economic hubs. Farmers would deposit grain into temple storehouses. In return, temple scribes would record how much each person had deposited. These records were written in cuneiform, pressed into clay tablets. The grain didn't move, but the ownership did. If one farmer owed another farmer grain, they didn't physically move the grain, they simply updated the tablet. This was money of account. Money that existed as a record of value, not as a physical object. Anthropologist David Graeber argued that this system came before coins, before physical currency. In his research, he concluded that credit systems were the foundation of money, not barter. People tracked debts long before they carried coins. In other words, money began not as something you held, but as something you owed, and something you were owed. This changed everything, because it allowed transactions across time. You could receive something today and repay later. Trust became infrastructure. Records became wealth. Power shifted toward those who controlled the records. As civilizations grew, metals began to replace commodities as physical money, copper, silver, gold. Not because they were inherently magical, but because they were scarce, durable, and divisible. Around 650 BCE, in the kingdom of Lydia, in what is now Turkey, the first true coins were minted. Standardized pieces of electrum stamped with official seals. These seals represented authority. The value of the coin wasn't just in the metal, it was in the guarantee. A government declaring, "This has value." Coins allowed empires to expand, soldiers could be paid, taxes could be collected, trade could flow across vast distances. Money was no longer just local, it became imperial. But coins still required physical transport, and physical transport meant risk. The next major leap would not come from Europe. It would come from the Islamic world. Between the 7th and 12th centuries, the Islamic caliphates built the largest continuous trade network the world had ever seen, stretching from Spain to India, across deserts, oceans, and continents. Moving gold physically across these distances was dangerous. So Islamic merchants developed financial instruments that removed the need to carry money at all. One of these was the sack, the origin of the modern word cheque. A merchant in Baghdad could deposit money with a banker, receive a written sack, travel to Cairo, and redeem it there. No gold carried, no robbery risk, just trust and paper. They also developed complex systems of credit, partnership contracts, and banking institutions. Merchants could invest in voyages without physically participating. Risk could be shared, profit could be multiplied. This allowed wealth to scale beyond the limits of physical presence. Banking became an industry. Financial networks became invisible infrastructure beneath visible trade. Europe would later adopt and expand these ideas. By the medieval period, banking families like the Medici built vast financial empires. They financed kings, funded wars, influenced politics. Because once money becomes information, those who control information control everything that depends on it. By the 1600s, another transformation occurred: paper money. China had already pioneered paper currency centuries earlier during the Tang and Song dynasties. But Europe adopted it later, through banks that issued paper notes representing stored gold. These notes were easier to transport, but they introduced a new concept: representation without immediate backing. The note itself wasn't gold, it represented gold stored somewhere else. This required trust in institutions, trust in banks, trust in governments. For centuries, currencies were tied directly to precious metals through systems like the gold standard. Every note represented a specific quantity of gold. This limited how much money could exist, because gold was finite. But in the 20th century, this changed. In 1971, the United States ended the gold standard under President Richard Nixon. The dollar was no longer backed by gold. It was backed by belief. This created fiat currency, money declared valuable by government decree, not by physical backing. From that moment forward, money became entirely abstract. Its value existed because people believed it existed, not because it was tied to any physical object. This allowed governments and central banks to create money in response to economic needs, to stabilize crises, to stimulate growth. But it also introduced something unprecedented: money that could be created from nothing but authority. The final transformation came quietly: digitization. By the late 20th century, money stopped being physical, even in daily life. Bank balances became numbers on screens. Credit cards allowed purchases without cash. Electronic transfers moved billions instantly. Today, over 90% of the world's money exists only as digital entries in databases. No paper, no metal, just numbers. Value has become entirely informational. Your wealth exists as data. Your transactions exist as records. Money has completed its evolution from livestock to grain, to shells, to metal, to paper, to pure information. And this raises a question: if money is information, then who controls the information? Because throughout history, money has never been just about trade. It has always been about power. The Sumerian temples controlled grain records. Empires controlled coin production. Banks controlled paper issuance. Governments controlled fiat creation. Financial institutions now control digital ledgers. Each stage increased efficiency, but each stage also concentrated control. Money began as something tangible, something physical, something you could hold. Today, it exists largely in systems you cannot see. Databases, networks, servers, maintained by institutions, protected by authority, dependent on trust. Money was invented to solve the inefficiencies of barter, but in doing so, it created something far more powerful. A system capable of organizing entire civilizations. A system capable of funding empires, a system capable of shaping history itself. And now, for the first time in human history, money no longer requires physical existence at all. It exists purely as belief, purely as agreement, purely as information, which means the real question is no longer what money is. The real question is who defines it. because whoever defines money defines value, defines power. And now, money defines the world you live in.